Hello, and welcome to my next NAP. NAP stands for Nonprofit Auditor Points, and I'm your nonprofit auditor. My name is Irina Ryshkova, and I have my audit practice in downtown Oakland, California. I designed these NAPs to help nonprofit community, board members, management, and accounting departments to understand better some accounting issues related to GAAP, General Accepted Accounting Principles, compliance, etc. Hopefully, you will find these NAPs helpful. Today, I want to talk about deferred revenue and refundable advances. This is very important in a sense to understand them because they are quite complicated concepts and they pertain to different type of revenue. Let's start. So first and foremost, you need to understand that both deferred revenue and refundable advances are liability accounts, and they do show as a liability on the balance sheet. And both of them can appear on the nonprofit balance sheet only if nonprofit receive funds, money, before nonprofit becomes entitled to these funds. Meaning, nonprofit cannot have deferred revenue or refundable advances if the money were not received. So the only way deferred revenue can be recorded, deferred revenue or refundable advances can be recorded if the money received. But nonprofit is not entitled to these funds yet. So they're holding the money until nonprofit either becomes entitled to these funds and they record as revenue, moved from deferred or refundable advances to revenue, or if nonprofit never becomes entitled, nonprofit have to return the money back. That's why it's called refundable advances or deferred revenue. Okay, so let's start. If you have accounting degree, went to college, took accounting class, most likely you've heard the term deferred revenue. And it's because this term is much more commonly used and it's used for profits and nonprofits. Because deferred revenue relates to earned income. Exchange transactions, earned income. Nonprofits do have earned income. Therefore, if nonprofit have any type of earned revenue, that would be recorded, and if the money received prior to nonprofit earning the money, that would be recorded as deferred revenue. For example, membership dues. If nonprofits collects memberships and they run from January 1st to December 31st, and on December 30th, a member paid for future year membership, that would be recorded as deferred revenue. Once again, because it's exchange transaction, it's earned revenue. It's not a grant, it's revenue. Therefore, and the nonprofit received money ahead of providing services, meaning membership for the next year, that's called deferred revenue. Another term for deferred revenue is unearned revenue. It's much more easier to understand, means that nonprofit have not earned it yet. It will be earned at the end of the next year, and then nonprofit will need to remove it from deferred revenue and move it to revenue. So initially, when nonprofit received, let's just say $1,000 on December 30th, for the next year membership, nonprofit will debit cash debit for $1,000 and credit deferred revenue or unearned revenue for $1,000. And at the end of the next year, nonprofit will decrease deferred revenue, meaning by debit deferred revenue by $1,000 and credit membership revenue $1,000. Credit membership revenue, it's increased revenue. Reminder that revenue is a credit account, so increases on the credit side. That's what we do with deferred revenue. Refundable advances. That's in a similar nature, but it pertains to the grants, conditional grants. As we remember from my previous videos, grants recognized when they are unconditionally promised. And reminder, condition is when there is barrier and right of return funds. So when nonprofit receive unconditional grant, it records it right away as soon as it's promised. You debit receivable and credit revenue. However, sometimes nonprofit promised conditional grant when the barrier and right of return specifically outlined in the grant letter. And if that happens and nonprofit receive money ahead of time until this condition is met, that would be refundable advance. It cannot be recorded as a revenue. For example, nonprofit receive a grant and it says for $20,000, and it says we will pay you $10,000 upon signing the grant letter, and another $10,000 you will be entitled if you attend a conference in Texas that will be held in May 2025. Even though grant for $20,000, we can see that first $10,000, it's unconditional because it's just simply administrative function. You need to sign the grant letter. Another $10,000, it's specifically conditioned that you will be entitled to these funds if you attend conference in Texas in May 2025, and if you're not attending it, you have to refund the funds back because you're not entitled to this money. That's a condition. So you cannot recognize it as a revenue, but let's just say the funder, today is December 2024, funder send you full $20,000 on the grant. What happened? You can recognize $10,000 unconditional as a revenue by debiting cash and crediting revenue. But another $10,000 you cannot recognize as revenue. It will be refundable advance because this is a condition on a grant. You will debit cash and credit refundable advances, which is a liability account because it's a conditional grant. Then when May 2025 will come and you will attend the conference, you met that condition, then you can remove refundable advances by debiting refundable advance liability account and recording it as a grant revenue for $10,000 because the condition is met. Just to summarize, remember, the deferred revenue relates to earned revenue when there's exchange transactions, goods and services provided, and typically relates to membership dues, event tickets, sales of t-shirts or any other supplies that the organization sells, something that is exchange transaction, meaning the person that pays the services receive the service in exchange. That relates to deferred revenue, and it's recognized as deferred if the nonprofit received funds before services were provided. And if services will not be provided, deferred revenue, money will need to be refunded back, or once services is provided, money will be recognized as revenue. Versus refundable advances, they relate to grants, not exchange transaction. It's actually when three parties involved: donor, nonprofit, and whoever benefits from the services. And therefore, there are specific obligations that needs to be fulfilled, meaning there is a specific condition on a grant exists that needs to be met in order for nonprofits to become entitled to this grant. So once the condition is met, then nonprofit can decrease refundable advances and record them as a grant revenue. So it's applicable to conditional grant. And just to remind you guys, that condition have to have two prongs: specific measurable performance barrier and right of return funds. If both of them exists, then there's a condition. If only right of return funds or barrier exists, then it's not a condition. Condition needs to have both. And that's the difference between deferred revenue and refundable advances. And because nonprofits very often supported by grants and also have some earned revenue, if the funds receive in advance, nonprofits should have separate accounts for deferred revenue and for refundable advances. Thank you so much. Hopefully it was helpful. Thank you so much for listening, and see you next time.